Will Indian rupee slide further? This is the major doubt in the minds of many, because in the financial year 21-22, the value of rupee compared to dollar has fallen by 3.53%. In fact, in the previous fiscal, that is 2021, the value of rupee against dollar has risen by 3.32%. So therefore, this financial year ended with the rupee value at 76.98. So just little less than the 77 rupees per dollar. So the question in the minds of everyone is, will the rupee appreciate or depreciate further? So this is the question before us. In fact, dollar is facing a serious challenge, with many countries trying to trade in the local currencies. Russia is already working out arrangements in like rupee ruble arrangements, and Russia is trying to engage with China in the local currencies. China is trying to engage in trade with Saudi Arabia in local currencies. Iran is also following the same. So there is an increased pressure on dollar. But still, when it comes to Indian rupee, there is a consistent fall in the value of rupee compared to dollar. So why is this happening, and will it happen in future? So, well, couple of factors have led to this kind of a situation. The first thing, the reason for this is the increasing global crude oil prices. The global crude oil prices have touched $130 mark on March 1st, owing to Russia-Ukraine war, because Russia is the second largest exporter of oil and the first largest and the largest exporter of gas in the world. So therefore, the oil prices are surging, and there is also a talk of American Federal Reserve, which means equivalent to the Reserve Bank of India in India, is toying with the idea of increasing the interest rates. Whenever interest rates rise, there will be an outflow of foreign money, and there is a decline in the inflows of foreign money of different kinds. So all these factors have led to the depreciation of the rupee when compared to the dollar. So what is the forecast for future? Well, the first thing is the trade deficit. The trade deficit in India is widening. In fact, recently the Prime Minister in his Mann Ki Baat talked about the record exports. It's true. India's exports have touched $400 billion for the first time. So it's truly remarkable. So India's exports are today valued at $418 billion. Certainly this is a great achievement. But the fact which he did not tell is also a similar, not a similar, in fact a greater surge in imports. In the last fiscal, when exports increased by 43%, the imports increased by 54%. So therefore, there is a huge trade deficit. Today, India exported around $418 billion, whereas it imported goods worth $610 billion. Therefore, the trade deficit is around $192 billion. So this huge trade deficit has resulted in even current account deficit also. Current account deficit is the gap between the foreign exchange earned and foreign exchange spent. So India has a current account surplus of 1.7% of GDP in 2021. Now in 21-22, between April and December, India's current account deficit of 1.2%. So we have moved from a current account surplus economy to current account deficit economy, especially due to the sudden surge in the global crude oil prices. So now let us take about the future, the predictions for trade deficit in the coming future. Well, exports will face a serious challenge because the global growth is slowing down. The International Monetary Fund, the World Bank, the American Federal Reserve were revisiting the growth forecast. For example, the US Federal Reserve earlier predicted that the American economy will grow by 4.1%. Now it has revised it to 2.8%. Similarly, the IMF and the World Bank have also lowered their growth projections. Earlier, IMF said that the world economy will grow by 5.9% in the year 21-22. Now it has revised this figure to 4.4%. Similarly, World Bank has revised this figure from 5.1 to 4.1%. So there is a clear deceleration anticipated in the global economy. So when the growth slows down, obviously exports will be dampened. So India's export potential does not just depend on Indian capability to export, but it also depends on the global demand. When there are no people to buy in the world, however competent we may be, we can't export. On the contrary, the imports continue to surge, and there's every indication that imports will further surge. Why will this happen? Because the global crude oil prices is still surging. So oil is the single largest commodity which we import. Oil imports alone account for 28% of India's total imports, because India's import dependency in the hydrocarbon sector is as high as 85%. So the oil imports have been rising because the global crude oil prices have touched $130 per barrel on March 1st due to Russian war on Ukraine, and it has now come down to around little less than $103 per barrel. But the market experts believe that the global crude oil prices will be somewhere in between $90 to $130 per barrel. So thus the import bill will continue to widen, because when in the budget the finance minister expected that the world oil prices will be on average around $75 per barrel. So contrary to the budget expectation, the global oil prices will remain high in the coming days too, resulting in higher value of imports, leading to further widening of the trade deficit. Then the next comes the gold imports. Gold is the third largest commodity which India imports. Gold accounts for 8% of India's imports. Gold is considered to be a safe haven when there is an hyperinflation. Gold is considered to be safe haven when there is a global uncertainties. So the Russian war on Ukraine has created a lot of uncertainty and unpredictability in global politics and economy, and the world is witnessing hyperinflation. The war has also contributed to the further rise in inflation, because the wheat prices have risen by around 50%, steel prices have increased, crude oil prices have increased, so the inflation is on the rise. When inflation is on the rise and the uncertainties remain in the world, the gold is considered to be a safe haven. So the gold prices are expected to further rise, increasing the overall dollar value of India's imports. So the imports are clearly rising, and exports have very serious challenges due to sluggish global growth projection. So this results in further widening of the trade deficit, which is already around $192 billion. So higher trade deficit essentially mean greater pressure on Indian rupee. So in fact, in the recent past, the Reserve Bank of India has intervened and spent its reserve foreign exchange to increase the supply of dollars. For example, on March 1st, India has a robust foreign exchange reserves of $632 billion, little less than $632 billion. To be precise, around $631.9 billion. So this has now come down to $606.47 billion. So around $606 billion, because Reserve Bank of India has released dollars into the market, so that the pressure for dollar will come down and the rupee will strengthen. That's the reason in the recent couple of weeks, in fact, the value of rupee has not just stabilized but has improved. Otherwise, it would have been slided below 78 also. So, but how long the Reserve Bank of India can do it? So, when the trade deficit is widening, obviously, when foreign money flows are coming down, so the Reserve Bank also cannot squander away its foreign exchange reserves. Not just the import-export problem. Look at the outflows and inflows. The FDI in this year have come down by 16% compared to the previous year. The foreign portfolio investment. So in the last fiscal, the 21-22, there is the foreign portfolio investors have pulled off around $18 billion of foreign portfolio investment from Indian stock markets. On the contrary, in 2021, that the previous year, actually there was an addition, there is an inflow of foreign portfolio investment, net inflow to the tune of $38 billion. So from $38 billion of net inflow, now there is $18 billion of net outflow, which means there is more foreign money is leaving India rather than coming into India. So on one hand, our exports may not sustain, imports will certainly grow, the foreign money flow is declining. So all this essentially mean tremendous pressure on rupee, even straining the Reserve Bank of India's ability to intervene also. Therefore, the market predictions are negative for the value of rupee in the coming days unless the dollar takes a very, very strong beating, which is certainly unlikely at this given point of time, but nothing can be told about in this volatile market.